I'll say it this way. There's two main agencies that purchase conventional loans. One of them is Fannie Mae, one of them is Freddie Mac. Fannie Mae is just a slang term for Federal National Mortgage Association, and Freddie Mac, that term is for the Federal Home Loan Mortgage Corporation. And they're just basically two mega huge companies that buy conventional loans. They have their own insurance. We traditionally call it PMI, private mortgage insurance. And so if on a conventional loan, if a lender loans a borrower more than 80%, then there will be private mortgage insurance paid in some version. So FHA and conventional, they compete with each other, and they both have pros and cons. One of the things I want to just have people think about is that we make loans for 30 years all the time, but statistically, the average life of a loan is only 7 years. And if we have someone that's a first-time home buyer, then the average life is typically only about 5 years. And the reason for that is because if you're a first-time home buyer, you're typically a younger person, and you have lots of life events ahead of you. You are likely, to be changing jobs, climbing a corporate ladder, relocating for a job, getting married, having kids. All those are major life events that would create a situation where someone would need to change their housing. So just keep in mind, average life of a loan is only about 5 years. Another thing I kind of want to kind of explain is that when a house gets sold, that doesn't happen for free, and so there's typically a 6% real estate commission, and then there's typically some amount of money that a seller may pay on behalf of a buyer to pay buyer's closing costs to help a buyer get in the property. And a lot of times there are repairs that have to be made, to get a house ready to be sold. So there's usually, roughly around 10% of the sales price that are wrapped up in expenses. So just kind of put a pin in that. We'll get back to it. All right, so let's talk about some of the features of FHA. So the minimum down payment for FHA is 3.5%. And then they have the mortgage insurance we talked about. It's paid two different ways. The first way is we take the sales price, we subtract out the down payment, and then we take that becomes the result is the base loan amount. So we take the base loan amount times 1.75%, and then that gets added back to the loan to get to the total loan amount. And then after that, we take the base loan amount again, and we take that times 0.85%, and we divide that by 12, and that amount is built into the payment. If someone makes a larger down payment, 5% or more, then that drops from 0.85% to 0.80%. And so it's a little bit of a help there if someone will make a larger down payment. Typically, when the loan is made, if the down payment is less than 10%, then the mortgage insurance will be on there for the life of the loan. If someone makes 10% down, then the mortgage insurance will go away in 11 years. Let's see, on FHA, the rates tend to be better. The amount of better depends upon the market. There are sometimes when there's quite a disparity between FHA and conventional, and sometimes they're not that far apart. So we need to pay attention to what the rates are, of course. But we also want to do a comparative analysis of the mortgage insurance between FHA and conventional to determine what is going to result in the lowest total payment. On FHA, rates, it tends to be a better product when we're dealing with someone who has lower credit scores. The reason for that is when someone goes conventional, the lower the credit score, the lower the rate or the higher the rate they're going to get. Where FHA is sort of a pass-fail. So if someone has a 640 score and someone else has a 850 score, those two people are going to get the same rate. It doesn't matter. Where on conventional, the credit score does matter. One thing about FHA is that their property requirements are a little bit more stringent. So if we are doing an FHA loan and we send an appraiser out to appraise that property, they are going to look at that property with a little bit more. They'll be a little bit more strict on what the any repairs that would have to be made. So they may look at a broken window pane and say this has to be replaced, where on a conventional loan, the appraisers would likely not mention it. So in a way, it's a double-edged sword. So if we have a buyer who goes FHA, then a lot of people would think, oh yay, I get to have an appraiser who's going to create repairs that a seller has to make for me, and that is good. However, there are some sellers who will not accept an offer on someone who is going to utilize an FHA loan because they don't want to make these repairs. So you have to be careful about what the strategy is that you use to determine the loan type on what you will offer. And you just need to consult your real estate professional on that because they have intel on what the house is. They know information, through the listing agent as to what the best strategy is to get your offer accepted. If we go FHA, that would be owner occupied only. They don't do anything else, so you would have to you'd have to occupy that property. We can do anything from our world is 1 to 4 family residential, so you could buy a fourplex and live in one unit, and that would be considered owner occupied. So it doesn't necessarily mean that you would be precluded from doing a fourplex or a triplex or a duplex. The rule is you just have to occupy one. One thing that's worthy of note is on every loan has a limit on what a seller can pay towards buyer's closing costs, and on FHA that amount is 6%. So if we had a sales price of $100,000, then a seller could pay up to $6,000 towards buyer's closing cost. So on conventional, it's commonly not that much, but theirs is variable based upon the amount that somebody puts down. But so let's just talk about conventional. When we go conventional, the minimum down payment is typically 5%. There are some circumstances where it can go to 3%, but most minimum downs for conventional is 5%. And like I mentioned earlier, the more money you put down and the better the credit score, then the better rate you get. So it's not pass-fail. Credit score and down payment matters. The PMI can be removed. So if you want to get, it can be removed 2 ways. One of them is you can petition for PMI removal, which basically means you would reach out to your servicer, whoever you're making payments to, and you would request that the PMI be removed, and they will have you send them money for an appraisal. They'll do an appraisal on the property, and then they will calculate the amount of equity that you have. Equity is simply the value minus the debt, and so if that amount is representative of 20% or more, then they would say you have 20% equity. They will review the pay history. There are some really quirky circumstances where they would not remove the PMI, but typically if you can document 20% equity and you've got a good pay history, they're going to remove it. The second way is that when a loan is made, they will calculate the number of payments it takes for that loan amount to become 78% of the value at origination. Okay, so when that loan gets to that number of payments, then the PMI will automatically come off. And they do that because if it wasn't for that, there would be people who they had a $100,000 loan originally, they paid it down and they only owe 40, and they're still paying PMI because they had forgotten they had it. And so Congress stepped in and created this way where the mortgage insurance would automatically come off, and that's why they do it. But most PMI is removed through the petition process. One thing about conventional is they're typically easier loans to do. There's not any government paperwork, which is typically, that can be onerous sometimes, and the process tends to be a little smoother, and sellers really like it when buyers go conventional. And another thing about conventional is conventional loan can be used for a second home, and it can be used for investment property. So just to understand so a primary residence that's a residence you occupy at least 51% of the time. A second home is a property that you occupy less than 50% of the time. And an investment property is a property that you would typically use for a rental. So we talked about the mortgage insurance. So on the monthly mortgage insurance for FHA is 0.85% divided by 12. So if somebody went on a conventional loan, if they had scores that were above 720, then their mortgage insurance, depending upon score, would be either 0.41, 0.59, or 0.73% of the loan amount divided by 12. So at 720, that's when their scores become better than FHA's. So let's talk about reasons to go FHA. So one of them is if you have a borrower, if you are a borrower that has a credit score that is 680 or less, then more than likely FHA would be would offer you the best way to go. Another reason would be for if a borrower has deferred student loans. So if we go conventional and someone has deferred student loans, we take the sum of all of the loans that are deferred, and we take those loans times 1%, and that would be the amount of payment that we would have to use to amortize those student loans. If we go FHA, instead of taking 1%, we take 0.5%. So, in these days it's common for someone to have, over $100,000 in student loan debt. So if someone with $100,000, if they went FHA, I'd have to count $1,000 a month in debt for them. And if they went FHA, it would be $500. So FHA has advantages when it comes to student loans. Also, when it comes to medical collections, so FHA basically says if it's a medical collection, we really don't have to worry about it. Medical collections can certainly draw down a score, and you will still have to meet score requirements, but when it comes to the collection itself, we're really not going to do much about that. The whole idea of credit scoring is so that we can determine a borrower's ability and willingness to repay debt. And medical collections are a very poor way of an indicator for that. And the reason is because someone could have an 850 score today, get in a car wreck on the way home, and 2 months from now have a score that would be significantly less than that, and really none of that was the borrower's fault. So when it comes to the medical collections, we have a tendency to look at that with an element of leniency to it. Okay, so another reason to go FHA would be if somebody's had a bankruptcy. And so typically on an FHA loan, if they've had a bankruptcy and they have reestablished credit, and the reason for the bankruptcy was circumstances beyond their control and unlikely to reoccur, and there wasn't real estate involved, then we can usually do a a new loan at the 2-year mark. Okay, where when we go conventional, it's more than that. So those would be things that would be where the FHA loan ends up being better. On a conventional loan, we talked about how conventional is just simply an easier loan to do. If the house needs repairs, then we typically want to go conventional because we want an appraiser to not call out a lot of repairs. So sometimes I do loans for people where they're going to buy a house and their intent is to remodel it. So we don't want to, if we went FHA, a seller may have to repair a floor that the buyer intended to rip out and replace anyway. So in those circumstances, we want to go conventional so the appraiser doesn't call that out, so we're not having to duplicate expenses. If someone is going to be in the house for long term, like if we know that they're going to be there, say 11 years or more, then we typically want to go conventional, because if they go conventional, the mortgage insurance can come off. Where if they went FHA, more than likely it would not come off. So that's the reason for that. FHA has loan limits, and so if someone is buying a house and that sales price is above FHA's loan limits, then we might have to go conventional, just simply because FHA can't do it. And then lastly, if a borrower, like if we're doing a loan for a first-time home buyer, I like to see if we can go conventional, because if they're only going to put 3.5% down on an FHA loan, and then I'm going to finance 1.75% back, then at the time of closing, they have very little equity in it. And so if they want to sell in 5 years, then it could be difficult for them to do that, because they would not have created enough equity to cover, to be able to pay for the realtor's commission and closing costs that they might have to pay for their buyer and any repairs that they have to make. So a first-time home buyer going FHA, if they sell in 5 years, it's quite possible that they may have to bring money to closing in order to sell. Whereas if they go conventional, they put 5% down, there's nothing added back, so their equity is 5%, and so at the end of 5 years, then they just need to have increased their equity by at least 5%, and then they're able to sell. So those are the kind of the pros and cons of both products. They both have their advantages and disadvantages. There's not one better than another. I hope you enjoyed this, and if I'd like you to visit Mortgage Mojo, and I'll be depositing various videos there for just generic information about mortgage stuff. So, and if you have any questions for me, you can reach me on my cell, 405-615-4096. Thanks.